Hello and welcome to a video introducing ratio analysis. To be able to value a business, you first need to understand the business. You then need to understand the firm's financial statements. After you've reformatted the financial statements, you can uncover a lot of information about your firm via conducting ratio analysis. So let's learn how to conduct ratio analysis and what's important to look out for. Our aim in conducting ratio analysis is to calculate financial ratios from our reformatted financial statements, and that's going to give us a range of benefits, but two of the main ones, it's going to allow us to understand the operating and financial drivers of firm performance, and that's when we look back in the past, and that will give us a great basis to then look into the future and think about what might happen in the future. So ratio analysis gives us a great understanding of the firm's past performance, and that will then allow us to make sensible predictions into the future when we engage in forecasting. The most important thing to realize when you conduct ratio analysis is that ratios require comparison against some other benchmark before they're useful, before they actually give us much information. So if you calculate a ratio such as return on equity and you get an answer of 5%, 5% on its own you can't say is good or bad without looking at other information. So whenever we're doing ratio analysis, it's very rare that a ratio is either good or bad just because of the number that it gives out. We always need to compare it against other things and try and decide if it's indicative of good or poor performance for this firm in this particular situation. So when we're evaluating ratios, we're going to look at ratios over time from prior periods. So that would be called time series data. So we might look at our company's performance over the last 5 years, and we'll see how those ratios change over 5 years of performance. Then we can compare this year's performance to previous years using the firm as its own control. We could look at ratios of other firms in the industry, and this would be called cross-sectional. So, if you're looking at Woolworths ratios, you're definitely going to compare against Coles. You want to see for similar businesses in the same industry, what are other firms in your industry or what are your competitors doing with their performance? Are you performing better or worse, or are you roughly similar to the industry average? There are sometimes absolute benchmarks in performance, and these are often if there's regulation involved. So regulators, especially things like the banking industry, they have strong regulation about how much risk a bank can take on. So essentially their debt to equity ratio or their capital requirements are in regulation. So there are sometimes ratios that it must be below this certain level or it must be above this certain level if the regulators require that. Or you might have debt covenants. So if you're a firm and you have borrowed money from a bank, the bank might say, you must keep your current ratio above 3 at all times. You must keep your debt to equity ratio below 50% at all times. So in those cases, you might have some absolute benchmarks to look at, which you can judge your firm's performance against. And finally, we can do common size analysis, also called vertical analysis, just to compare your firm against other firms, adjusting for their size. So seeing their performance on a percentage basis. Okay, so the key thing to take away, you calculate a bunch of ratios for your firm. Before you can tell if these ratios indicate good or poor performance, we need to be able to compare it against other things. And that requires researching either your firm's historical performance, performance relative to their industry or competitors, performance relative to any regulatory or external benchmarks, and then we could do common size analysis to also look at them on a size adjusted basis. So let's look at how we'll do this. When you're conducting ratio analysis, it's really important that you try and relate the actual business, what's actually happening in real life, the decisions the managers are making and the products they're selling, relate those real life activities to the financial numbers. So if you see the firm's profit margin has increased during the year, it's not just enough to say the firm's profit margin increased during the year. You then need to go and look at why did the firm's profit margin increase during the year? What did the managers do? What changed in the business? What actually led to this change in the number? Because that's when we actually gain insight into the business's performance. The why did the number change? What is this number telling us and how did it? After you've done this, ratio analysis will aid your understanding of the business model of the firm, the returns that the firm generates, and the firm's risk. So it's going to give us a great picture of the overall position of the firm after we conduct ratio analysis, after we start to understand the business factors leading to the performance. And finally, your goal is to tell a story about the business from the numbers. When you do ratio analysis, the most common mistake people make is they focus purely on the numbers. Last year's ROE was 3.5%. This year it increased to 4.2%. Therefore, the firm performed X percentage better. That's not very informative. It doesn't actually tell me what the managers and the business were doing during the year. It's much more important that you tell the story about during the year, the business released this new product, which was able to increase sales, and especially in this particular market, they gained market share. They had a merger or acquisition. All these things led to increases in the return on equity. Then we actually understand the reasons why. So keep that in mind when you're doing your ratio analysis. So when we're looking to value a business, profitability and growth are key drivers of firm value. So when we're doing our ratio analysis, we're always going to look at profitability and growth as key areas to look at. And within that, managers can use sort of 4 levers to achieve growth and profitability targets. Their operating management, what they're actually doing day to day. Their investment management, what assets are they buying, where are they investing their business, what are they planning in the future. Their financing strategy, and their dividend policy. So all 4 of these levers allow them to change their growth and profit targets. And it's important when we do ratio analysis and financial statement analysis, we look at all 4 of these areas. And finally, ratio analysis seeks to evaluate the firm's effectiveness in all of these areas and understand the risk of a company. Okay. Risk and return are always closely correlated. So as we're looking at the returns the firm has generated, we also need to be mindful of how risky is the business. So growth is reasonably self-explanatory. We don't spend a lot of time talking about how to measure growth because growth in sales revenue is going to be the number one area of growth that we look at when we're analyzing companies, and it's a percentage change. So sales growth equals the sales revenue at time t, which is the current year, minus sales revenue at t minus 1, the prior year or prior period, divided by your sales revenue at t minus 1. That gives you a percentage change. So we're just looking at, is our revenue growing either from half year to half year or year to year as we look at our financial statements, getting a pattern and understanding of if the business is successfully growing. And there's also a sustainable growth rate, which is often used as well. The sustainable growth rate is equal to the firm's return on equity times 1 minus the dividend payout ratio. And that gives you the maximum growth rate without needing external financing. So that's how fast a business could possibly grow if it wasn't going to borrow money from the bank or raise more capital or anything like that. So it kind of gives you an idea for forecasting purposes, what would be the maximum rate that this business could possibly grow given their current returns and their current financing payout policies. So in conclusion, when you do ratio analysis, you must compare the ratios you calculate against some sort of benchmark that's appropriate for your firm. Ratio analysis is going to be very useful in identifying key areas of success or concern for the business that you're analyzing. However, the most important step, you must understand the reasons why the ratios are changing and be able to tell a story about the business performance. If you just calculate the ratios and look at the numbers without understanding the business, you're not going to get a very good idea, and the report you write won't be very interesting or informative. You must get an understanding of the real business activities that are driving the financial performance numbers and driving the financial ratios that you calculate. With that in mind, you'll be able to do a good ratio analysis and you'll be able to get a much better understanding of the business that you're looking at. Thank you.